Hello, everyone. Welcome back to our summer series, as I'm calling it in 2023. For this conversation, we have Chris Cook of Beacon Capital Management joining us. You've seen Chris before if you've been a part of these video conferences live. I, as always, promise no charts or graphs, just a good conversation. So, Chris, welcome back. Thanks so much for joining us. Always a pleasure.
Always a pleasure. Thanks, Lou.
Yeah, everyone looks forward to our conversations. Because we keep it relaxed, which as I was in our previous video, I'm keeping it more casual for this recording. But we are going to jump right into the professional conversation, and I'll put you right on the spotlight. How did we get here, Chris? We're in July of 2023. Tell us how the market reached this point, which is a point where there is a lot of conversation about how well the market is doing. How did we get to this point with so much negativity, we'll say, coming into 2023?
Yeah, that's a great question because, a few things have happened this year that's been interesting. Really, I think the biggest thing that we're starting to see is that there's progress on inflation, right? So the Fed has been very aggressive raising rates. Everybody's seen that. You see it on the headlines. If you go get a mortgage for your house, you're pushing 7% now. So the Fed has done a pretty good job at methodically slowing things down without pushing us into a full-blown recession. Now there's lots of people out there that can talk about what's called a rolling recession. There's certain sectors that aren't doing very well, and they are, declining right now. But overall, the economy is still, on solid footing and doing well. So the stock market, though, always likes to look out, at least, 6 to 12 months. And some people say nowadays, even further than that, 18 months. So they're looking out and saying, all right, the Fed has told us we're probably going to raise rates, here in a few weeks in July, and then, maybe one more time, but probably done, by the end of the year. So the market can see the end of that pain happening, and then it starts focusing on what happens after that. And if earnings can hold up, people can stay employed and they have money to spend, then everything should be, pretty good. And we get inflation under control. So, the market has rebounded a lot this year. What's been interesting, though, is it really was not a very broad rally, for most of the year. If you look at the market from January through the end of May, for example, really the top 7 stocks in the S&P 500 controlled about 99% of the performance. They were it, and rightfully so, because they were about 90% of the earnings, for the S&P 500. So they were getting all the attention. We're talking about the massive companies like Apple and Microsoft and things like that. So now, up until that point, we really didn't have a lot of confidence in that rally. But, to try to get to the end of the story, to answer your question, though, the market has broadened out a lot in the last month and a half, actually. And other sectors are starting to come into play beyond technology, beyond those 7 companies. In fact, one of the best measures to see how the market is doing health-wise is how are the small companies doing? In the industry, the benchmark would be the Russell 2000. It has rebounded quite a bit. Just in the last month, small companies themselves are, depending on what benchmark you want to look at, up somewhere between 5 and 10%. In a pretty short period of time. So that's good news. Again, all the other sectors are starting to get involved now. It's not just tech. So that's giving us a lot more confidence to where we're at right now.
So a broadening market increase, which of course feels good, looks good. We talked a little bit about it, preparing for this, that we are still in a overall, if you take the measurement of the last 19 months, the broad stock market, the S&P 500. And just to point it out, because I think it's necessary, the 500 are 500 stocks. That's just, we all speak financial advisor, if you will. And I always want to take a pause and remind ourselves that we're talking about 500 companies only in a stock market that includes over 10,000 listings. So it's a very small portion of the market that we're looking at as this be all end all of a benchmark. You brought up the Russell 2000. I love the Russell 2000. All right, for lack of a better way to put it, that's not a suggestion to invest in it. That just means as a benchmark, I like it. But here's what I'm getting at: the small company stocks joining in. Is it all a matter of the Fed that has helped them join the party, if you will, of increase? Are there? You said it's a forward-looking. We'll call it entity, the broad markets, the psychology of the market forward looking. What has caused small company stocks to join in? Is it only Fed action, or is there more to it, in your opinion?
Well, a lot of it, is, the Fed, so smaller companies, they're still in that hyper growth mode. They're trying to become the big companies of the 500, the biggest companies out there that most people are looking at all the time. And the first place to get money is, for loans, just like all of us, if we want to go do something, buy something, we borrow the money. So if those companies are looking out ahead and they feel like, okay, the interest rates have peaked and they may come down a little bit, that is going to make their life a little easier and be able to grow a little bit more. Plus some of the inflation data, it's coming down. Smaller companies don't have the bargaining power that, say, like Walmart has. Walmart is the largest retailer in the world. They can put a lot of pressure on all of these suppliers and say, no, we're not going to accept the full brunt of these increases. The mom and pop, grocery store, they can't do that, but they're going to take it. And so that is going to help those smaller companies a little bit more. So people are starting to recognize that, and other companies are getting involved. Like I said before, the real problem was it wasn't just what you and I would have considered concentrated in the past, where you say maybe 25% of the companies, are carrying the load. That's concentrated, but not horrible. That's what the term everybody likes to throw around is the generals. The generals are doing the work versus the soldiers. We were talking 7 companies. I mean, right. You talk about 500. Yeah. So, it was a very small group, but they happen to be the largest companies in the benchmark. So they carry all the weight, and, when those overlap, it really skews things, quite a bit.
So it's good to know that you're out there looking for loans. I'm purely a cash and carry kind of guy. Okay.
Good man.
That's all right. What could push this market forward, even farther than it is than we're looking at right now? Which a lot of the work, I do like the generals and the soldiers' thought on that, but a lot of the work or increase has been, again, we're in July here, just mid-July. A lot of the work or gain has really occurred, I'll say, over the last 6 to 8 weeks. Mm-hmm. What keeps it moving forward longer in 2023? What will the Fed do? What's out there in the world that gives us more hope, if you will, for the market to continue moving forward or upward?
Yeah. So for us to have confidence, we just went past a couple key metrics, the consumer price index and then the producers price index. They came out yesterday and today, and that's what's propelling the market the last couple of days. And both of those are inflation measures that are coming in better than expected. So not only have you continued the slowing trend that the Fed needs, but it's accelerated a little bit beyond what anybody expected, not by a lot. So that's good news. If it falls off a cliff, that means we're probably going through recession. So we don't want that. We still want it steady, but slowing. So those numbers are getting down into that 3% range. And that's historically not a bad area. The Fed is targeting 2%, but that 2% historically is really low. We didn't really start targeting 2% until after, the great financial crisis, in 2008. So that's when we took rates down to 0, basically, and we were trying to get inflation. We could barely get 2% inflation. So that became the target. But if we look over history, back the last 100 years, inflation runs about 3.1% on average. So we're getting into that normal range. So that's a good sign right there. But really, what we need to see, we're entering earnings season right now, for the quarter, and we've really only got a couple companies that have rolled out earnings as of right now when you and I are talking. So it's Pepsi and Delta Airlines. Both have done very well, which you would expect. Pepsi is a very recession, proof, business, very stable. Everybody likes to drink their sodas. Everybody likes their snacks, so it doesn't typically move a whole lot. And anybody that's been on, an airport recently knows that they're packed, and fuel costs have come down. So that's good for Delta. So no surprises today. What we'll find out is when the rest of the other 498 companies in the S&P 500 over the next few weeks, as they roll out their earnings, how do they do? So most of the expectations have been lowered, rightfully so. Now the question is, are they going to be worse than what we expected, or are we going to come in a little bit better? And so far, indications are that they'll probably be at least on expectation, maybe a little bit better, and that will help, us move forward. And earnings are always the most important thing. I mean, if we think about what investing is, at its basic level and the fundamental level, we're buying earnings. We want to own companies that generate cash, and profits. So, and those are the ones that over the long term, do well. And in the market, historically, it gets a little disjointed or out of whack sometimes from earnings, but eventually it always kind of comes back to it and gets pretty close.
All right. Well, thank you for that. And it gives me an opportunity to say, as you said, keeping it fairly simple.
Yeah.
Green numbers are good and red numbers are bad. Okay.
Yeah.
So let's go to that side of it, because I think we need to. What causes it to stumble? What are the outcomes of any number of these different elements that are propelling it forward? And then some, we'll say, as I spoke with the last guest about war in Ukraine, that is something that has to be factored in. Give us Beacon Capital Management's input on what could cause this market to stumble.
Mm-hmm. Yeah. So right now we're in this nice area of kind of Goldilocks, for lack of a better term. So things are kind of going towards where the Fed wants them to. Prices are coming down. People are still working and still spending enough money, but not too much. So we're in this pretty nice area right now. Really the fear is that we have another spike in inflation. People get too comfortable, and honestly, a lot of that comes down to the labor market right now. If you want a job, you can probably find one. May not be the ideal job, but you can find a job, and it's probably paying significantly more than it did pre-COVID, right? So, and let's face it, in America, we like to spend money. We are a consumer-based economy. If we make money, we tend to spend money. Versus a country like Japan, part of their culture is saving. They make it, they hoard it. But here we like to spend it. So if the labor market continues to be hot and wages continue to go up, and we have money in our pocket, we're going to spend it. That could cause some problems, and that's where the Fed is watching the labor market pretty closely. It's showing signs of at least stabilizing. It's not getting any hotter. So that's good news for them.
Well, labor inflation is going to be a challenge moving forward. It could be a real problem. And the other side, the flip side of it is most of the tools that the Fed uses, are pretty slow moving, type tools for them to work their way through the system. They're very blunt, so it's hard to determine at a specific point in time, like now, how much of an effect they are going to have on the economy. As they've raised rates significantly over the last, year and a half,
they still don't know exactly what the longer term effects of that are. So if they come in too hard and basically they just slam on the brakes too hard, the economy will go into a recession, and that will be bad for the stock market, because then people will start losing their jobs, people start spending less money, and then you've got that whole problem. So those are the two scenarios that are very financial related that we're worried about. They're definitely on our radar. Now, there are, modern times, and I guess it's always this way. We always have, external risks, outside of the financial world.
Sure.
That you just don't see coming. One we kind of know is happening, like you mentioned, Ukraine. Taiwan is probably the biggest one that we're watching, right now. We've seen the issues of when we can't get enough chips for various products, automobiles, et cetera, computers, phones, you name it. I mean, our world lives on these things now. And Taiwan is a primary manufacturer of chips. And so if something were to happen there, we're not prepared, for that. There will be a supply
Hard stop, if you will. Sure.
Yeah.
And they brought Pepsi and snacks and now chips, computers, conductors. You got a food theme going here inadvertent. But it's a good point. Geopolitics are as challenging as they've ever been. And of course, I've said this more than once. Let's hope there's some kind of resolution to what's going on in Ukraine quickly, not for the stock market, but for mankind. Okay, that's what we're rooting for there. So with all of that input, and it's quite a bit to take in a short video here, which as promised previously, I like to keep these to about 20 minutes now between you and I having a good conversation. Look into the Beacon Capital Management crystal ball and give us a look just to the end of 2023, if you don't mind. Probability of success, if you will. The probability this carries forward and we get there, we get across the December 31 finish line in, well, I'll say positive territory.
Mm-hmm.
You can extrapolate that to the stock market, bond market, however you'd like.
Mm-hmm. I think the probability of getting to the end of the year in green numbers, as you mentioned before, are pretty high. I believe the Fed is on the right pace right now, and they may very well be done here in a couple of weeks. They'll most likely raise rates again and then potentially be done. But if they're not, there's probably only one more left, and that'll be sometime in the fall. And I do think the market digested everything last year. It really took on everything all at once. It didn't matter where you were at, whether it was stock market, bond market, whatever. It was a bad year, and a really bad year. And so we are coming from such lows that I think that created a little buffer of safety on the downside. So we may not go screaming up, and we probably don't want that actually. But I do think there's a very high probability that we are higher at the end of the year than we are right now.
And again, for compliance purposes, and we are serious when we say that, it's not a recommendation to buy or anything like that.
Absolutely,
but it is a good conversation. So
there's no question. My crystal ball is broken. That's for sure.
Let's just leave it at yours is less cloudy than the rest of us who are following your direction. But as someone said it to me today, it could be time to put optimism back in the portfolio. I really like that one. And you know what? I think that's a good place to leave it, unless you have something to add beyond that.
No, I love that phrase. That's a great one, and I might steal it.
You're welcome to it. Go right ahead. Chris Cook, Beacon Capital Management, thank you so much. As always, we'll do this again in the fall, and we'll recheck all conversation here and welcome everybody in to listen to that again. So thanks again for your time.
Great. Look forward to it. Thanks, Lou.
Always a pleasure. This webinar was created July of 2023 and is provided by Tranquilli Financial Advisor, LLC, for educational use only. The opinions expressed herein are as of date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any product. Tranquilli Financial Advisor and Beacon Capital Management reserve the right to modify their current investment strategies and techniques based on the changing market dynamics or client needs. There is no guarantee that their assessment of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results.